what I'm worried about is what is currently breaking. And, people say what's going to break, what's going to break. My view is that in a massively indebted world, to put this in perspective, the US is some 300 and something percent of GDP in debt as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. And everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghosts of the past. The ghost of the past, the 1970s, was wildly different. We've talked about this in Daily Briefing before. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere that the market's going, we cannot deal with rates like this and the liquidity that's happened. So liquidity has been drawn out by quantitative tightening. What they've done with the banks and what bank reserves have to be held has kept money out of the market. There's basically no buyer of the bond market. So there's a few charts I think Claire's going to try and share them. Bond market liquidity is basically as bad as it was in the peak of the pandemic when the bond market froze and everyone was worried Citadel had gone under, whoever had gone under. That's how bad the bond market is now.
Hello and welcome to Money Talks. In today's video, Real Vision CEO and former hedge fund manager Raoul updates about the market sentiments as Fed delivers another big rate hike to fight inflation. Raoul also explains the global liquidity situation and how the Federal Reserve will respond to another mess of its own making. Make sure to stick around till the end of this video where Raoul reveals why the central bank experiment of Volcker worship in a massively indebted economy is on its last legs in the coming month or two.
Yeah, I haven't changed. So I'm bonds. I've got 10s, 2s, 5s. I've got everything and euro dollars. And I am long crypto. So I've luckily added significantly pretty much at the low. So lower than here in ETH and Solana around here. And some other bits and pieces, and I own some technology stocks, which I bought down 75%. A whole basket, bunch of different ETFs, doing the whole exponential age from gaming to metaverse to AI to robotics to genetic sciences to EV, all of these mega big picture themes. So I just bought a very broad basket there, which is a long-term bet, which again, if it sells off any further, and it hasn't made any lows for a long time now, since June, I would add into that.
The U.S. Federal Reserve raised interest rates by another 75 basis points on Wednesday, with officials predicting a sizable economic slowdown in 2022. That puts the federal funds rate, or the rate at which the Fed lends to banks, at 3.25%, up from 2.5% previously. Reducing inflation will likely require a sustained time of below-trend growth, said Federal Reserve Chair Jerome Powell. We will keep at it until we're confident the job is done.
What that's done is decoupled the bond market from the underlying inflation story. So this is not a fear of inflation, really, because the Fed are saying we're going to do anything to kill inflation. Well, what's happened is the break-evens rate has agreed with that and said, yes, inflation is not the enemy. And break-even inflation, I'm looking at the 5 years, is at 2.4%, which broke down today. And 1 year is at 1.95. So they're basically around 2%. So the market's saying forward-looking inflation is back to normal. Okay, but the problem is if bond yields are going up and inflation expectations are going down, you see this next chart, Claire, which is real rates. Real rates have been trending lower over time. This is 5-year real rates. They trend lower because of debt and demographics. So you need to have low real rates to stimulate the economy or run it normally. So the trend rate of real rates is actually negative 1%. But we've just seen the fastest ever rise in real rates in history. So you're raising real rates on people at a time when they can't afford to service their debts because there's too much debt out there. So it's creating chaos in the bond market because the Fed have essentially gone too far with this whole mechanism between how the banks can use their balance sheets, plus quantitative tightening, plus raising the Fed funds rate. And the market's freaking out.
The Fed's latest quarterly economic forecast, which it also released Wednesday, shows a decidedly less optimistic view of the central bank's ability to curb inflation. Officials don't expect to see their favorite inflation measure, the Personal Consumption Expenditure Index, anywhere near the Fed's 2% target until 2024. So while 3 months ago officials predicted interest rates would be at 3.4% by the end of 2022, they now see the Fed raising them up to 4.4% according to Summary of Economic Projections, which collects the views of Fed's Board of Governors. They also no longer see the Fed backing off from interest rate hikes in 2023 like they had forecast in June. The median view of Fed officials is that the Fed's fund rate will be 4.6% by the end of the year, and then 3.9% by the end of 2024.
That dislocation has spilled through to the currency market as well. We've already been noting, dollar yen, right? That was a specific situation because there was yield curve control, so you're printing yen. Then the UK starts cutting taxes whilst raising rates, and what happens is the currency collapsed, and today the pound was down 3.5%. This is in the top 5 largest currencies in the world, and it's down and more volatile than the Nasdaq. This is extraordinary, but it's not just that. The Eurozone has got the same problems. South Korea, it's a mess. What we've got is a shortage of dollars, something I've talked a lot about and many guests have talked about. There is a global shortage of dollars. The Fed are taking dollars out of the system, and what's happening is the safety valve is the US dollar is skyrocketing. Now, what that also does is export massive amounts of deflation. If you look at the nations who are suffering the most, it's the world's biggest finished goods exporters: China, Japan, Germany, South Korea, Taiwan. They're all seeing massive currency declines. So this is finished goods. This is TVs and computers and chips and all of that stuff. So the US kind of likes it. It also geopolitically, they like it because they exert their power, which is the biggest power they've got is the US dollar. 87% of world trade is in US dollars, even though the US is 25% of GDP. But you're choking the entire system.
Fed officials also cut their economic growth outlook for 2022 in the face of declining output, global shortages, and money tightening. They now see the U.S. economy growing by 0.2% this year, down from the 1.7% they forecast in June. Fed officials have less of a dismal view of the labor market, predicting the unemployment rate, currently 3.7%, moving up to 3.8% by the end of the year and 4.4% by the end of next year. But some are skeptical about the Fed's projections, given the pace of expected interest rate hikes. An unemployment rate that rises from 3.5% to 4.4% is not an unemployment rate that just peaks at 4.4%. Everyone should assume that the Fed is committed to engineering a recession. So, do you think Bitcoin bull run is imminent? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.